Hello, and welcome to Monumental, where we sit down with entrepreneurs, leaders, visionaries, and big thinkers making monumental change. Here's your host, Evan Holiday.
Welcome to Monumental. I'm your host, Evan Holiday, and today on the show, we have on Paul Moore. Paul, great to have you on the show.
Hey, it's great to be here, Evan. Thanks.
Yes, so Paul is a successful entrepreneur and was twice nominated for the E&Y Entrepreneur of the Year before he got started in real estate in 2000. He's now managing partner at Wellings Capital, where they offer commercial real estate investment opportunities centered on providing stable, yield-producing investments to their clients. He's the author of The Perfect Investment, Create Enduring Wealth from the Historic Shift to Multifamily Housing, and he is also co-host of a wealth-building podcast called How to Lose Money. I love that title, by the way, and is a regular author for Bigger Pockets. So let's just jump right in and go into kind of your story before real estate and how you got into real estate.
Yeah. So I got an engineering degree, which was my first mistake. And I didn't really know myself, Evan. I wish young people, I hope they have better counsel today than I had. I didn't have any idea what I wanted to do growing up. And it was almost as bad as throwing darts at a dartboard. Like whatever anybody would say to me, or one of my parents' friends would make an offhanded comment. Oh yeah, I want to be in geology. That sounds fun. Rocks. And I had no real sense of what I wanted to do until I was in my MBA years later, and I realized, hey, I should have been doing marketing all along. But anyway, I went to Ford Motor Company for 5 years, had a great time there, and then I started my own company with a partner, and we sold it to a publicly traded firm 5 years later. And I found myself before my 34th birthday having a couple $1 million in the bank and no clue how to invest that money or how to invest at all, or nor how to invest my time either. I thought I'm going to be the best dad, the best husband, the best friend anybody ever had, great investor. And I failed at all those. I became kind of the worst version of myself. I was this type A driven, high energy entrepreneur. And I moved to the Blue Ridge Mountains of Virginia from Metro Detroit and got really quickly bored. And I thought I was investing. Investing is when your principal is generally safe and you've got a chance to make a return. And speculating is when your principal is not at all safe and you've got a chance to make a return. So I was a speculator. And I jumped into real estate investing a few years later, and I've been doing it ever since for almost 20 years. It's been a great time. I've done probably a dozen different things in the real estate investing world, but every one I think I get closer to what I was supposed to be doing all along, which is right now we're managing a couple recession-resistant funds with mobile home parks, self-storage, and apartments in the funds, and we're managing those, partnering with best-in-class operators, and we're enjoying it, having the time of our life.
That's awesome. That's a great story, and it's awesome that you had that early success, but yet you still felt like you didn't have the right direction. So how did you make that shift? How did that happen, where you found kind of the direction and purpose that you wanted to go down?
Yeah, honestly, it was through a lot of trial and error. And that's why, again, part of the impetus for our podcast, it's a wealth building podcast we have, but it's called How to Lose Money, because there are a whole lot of ways to lose money. And I think the problem as investors is we confuse entrepreneurship with investing. Entrepreneurs have to swing from the fence for the fences when they start up a new company quite often. But as investors, when we put our investor hat on, we shouldn't probably be swinging for the fence as much. I mean, if you keep playing double or nothing with all of your capital, you're going to land on nothing at some point. Then what will you have left to double? And that's the problem with speculation. Finish this sentence. Low risk leads to low return. High risk leads to
high return.
You would think, but it's not true. It's high risk leads to the potential of high return,
right,
and the potential of high loss as well. And it took me a long, long time to learn that lesson. We did a ground up development of some apartments that went phenomenally. We made millions of dollars. But then we did a ground up development of a Hyatt hotel, and it was a disaster. And, I mean, so I decided, when I was about 50 years old, I didn't want to be on the wrong side of a development gone bad. And so we decided to pull back and get into more, value add investing with best in class operators who really knew what they were doing, not learning it from the ground up as we went along.
Right.
So yeah, it was a process over 15 years, I'd say.
Wow. That's amazing that you took that time and that trial and error and learning as you went. And now with Wellings, you know the niche that you're going after of recession proof investing, and in partnering with key operators that know what they're doing and have a proven track record.
Right. Yep.
So going into today with Wellings, how are you finding the best in class operators?
Yeah, so we were really heavily focused on multifamily only, and I love multifamily. Like I said, I called it the perfect investment, and I go through in my book in especially chapter 4, 5, and 8, I go through the argument for why it is the perfect balance of risk and return and all that stuff. The problem is right now, as we all know, multifamily is somewhat overheated. And so we finally, after years, literally years of banging our head against the wall and, being outbid by people who had a lot more risk tolerance than we did in our 50s, we decided, let's expand our horizons. And we were shocked, happily, that self-storage and mobile home parks have a whole lot of mom and pop operators that leave a lot of meat on the bone. And there's lots of value add opportunities that I haven't seen in multifamily for a while. 93% of multifamily over 50 units is owned by corporations, and they've largely wrung out the value, but about 70% or more of self-storage and almost 90% of mobile home parks are owned by mom and pops. And they haven't typically wrung out the value. They typically don't know how to market. They typically don't have the resources or the desire to do all the modern upgrades they could do to get a lot more value and a huge return for their investors. So when we came to this realization a couple of years ago, we also knew that we hadn't done it ourselves. We didn't have a team who had lived and survived or even thrived through the recession. So we went out and tried to start finding those. And we have a rigorous process, about a 24-point questionnaire. We want to get a check mark on most of those. And so we talk to operators who've been at it, for a long time. They have a cohesive team. They have in-house accounting, in-house, a lot of different, property management, et cetera, all dialed in. They've got a conservative mindset. They've got a great track record. They got happy investors. We've talked to their employees, hopefully even talked to ex-employees just to see how they treat people. We've gone out to their sites. So we do a lot of due diligence on an operator. And then when we, agree to work with that operator, then we really dive in heavily with them.
So how did your team at Wellings, how did that come about, that formation?
The team at Wellings?
Mm-hmm.
Yeah, so I was working with another guy who's a dear friend for the last decade, and he actually he had a medical practice, and the problem was he kept hoping he could sell the practice. If we can only get a few more apartment buildings, then I can sell my practice, or if I can only get, and it just never came about. And so we through, I met him for dinner 2 nights ago. We're still good friends, but we had to decide, hey, this isn't really working because I'm giving my 60 or whatever hours a week to this, and you're only able to work on it on weekends and evenings. And so we decided to part company, and I actually hired I hired a college senior 4.5 years ago. And he's been with us, he's been with us over 4 years now, full time. And he was a perfect partner for this. So I actually brought him in as a junior partner recently.
Wow. So as far as going back, I want to go back to, the name of your podcast, and I know we talked about it a little bit before we hopped on here. Why calling it How to Lose Money, and what's the story behind that?
Yeah, for years I would go to these. My family's really important to me, and I would go to these father-daughter retreats at this beautiful resort in Georgia with one of my daughters, my oldest daughter, and we would see these people on stage, and there were the perfect husband and father type guys. And I'm not saying that sarcastically; they were great, great men. And they would tell all these wonderful stories about their family's adventures and how they went to Hawaii or Europe or mountain climbing or parachuting. And I would see, and they would talk about their wonderful families. And I would see the men around the table. We had like 10 people per table. It was father and a daughter. And I could see the people just kind of shrinking down in their seats. And we would do a group conversation. They would say, I'm a failure. I'll never be like that. I'll never be that good, because all the people would talk about is all their successes. And I even heard my daughter say, I'm kind of jealous of that family. I wish I was in that family, because they seem like they're always doing something adventurous. Well, I got to know some of these fathers and families, and I realized they were just like us. They had problems. They fought at home. They left socks on the floor, and they were just like us. And that actually encouraged me greatly, and it gave me hope. And I saw the same thing in business. I'd hear people trumpeting all their successes, and that's great. But you know what? When I found out they had great failures and pain and doubts along the way, I actually felt encouraged. I thought, well, there's hope for me too. And so I thought, if I ever start a podcast, I am going to talk about problems, pain, failures, loss, and self-doubt, and how those people can still succeed, to give everybody hope. And so that's what we're about at How to Lose Money.
Yeah, I love that, and it's catchy. I mean, that's a great way to lure people in. It's like, well, what does he mean lose money out? Why would I want to lose money? That's the
Is that
opposite of
right?
what I want to do.
Exactly.
And you're exactly right. I mean, that reminds me of, the whole social media effect of everybody posting the perfect version of themselves and
Mhm.
not sharing the full picture. And I think there has been a movement towards people actually sharing real stories and real failures, just like you all are doing with the podcast. So I commend you for that, because
Thanks.
it's powerful to show people it's okay to fail. That's how you learn. That's how you grow. That's how you make better decisions in the future.
Right. It's so true. People say, and there's lots of analogies I could give, but people say you learn so much more from your failures than you do from your success. And I think, in a lot of ways, easier to not replicate someone's failure than it is to replicate someone's success.
Yeah, that's a good point. Um, and we talked briefly about your personal story of losing money and having to fight through that. What was that like for you?
Yeah. So when we sold our company to a publicly traded firm in '97, I had a couple $1 million in the bank. And we found ourselves exactly a decade later, when one of my business partners came to me and said, I can't do this anymore. We were going into the recession. Of course, remember, Evan, we couldn't see what was coming. At the time, we thought maybe the recession was almost over in 2007. There wasn't even a recession yet, technically, but we knew there was a big slowdown in real estate. And so we were hoping it was almost over, but it was late 2007. And my partner said, I can't do this anymore. So we signed the deed of all these properties we had bought on speculation over to me, which meant I got the debt as well. And so I found myself $2.5 million in debt going into late 2007, again, not knowing how bad things were about to get. And so I was actually meditating one morning. We'll talk about morning practices later, I guess. But I was thinking, I actually had this crazy thought, WWGMD, which doesn't mean what would grandma do? It means what would George Mueller do? Now, George Mueller is one of my historical heroes. And he actually was a hellion who turned into a pastor and actually started orphanages in Bristol, England, And he basically operated these through for about 100 years after he was gone. Part of it, of course, they served like 10,000 total orphans, and they did it without ever having a fundraiser, ever doing marketing, without ever telling anyone their needs. And I thought, what would he do? Well, the first thing, he would never have been in debt in the first place, so I was already in trouble. But I thought if he would have found himself in debt, he would have done something completely countercultural, completely radical, and looked for a great outcome. And so what I decided was, I had a couple friends right around that time said, hey, can we meet? We want to talk to you about your finances. And they said, aren't you going to have to declare bankruptcy? And I said, no, I'm going to give my way out of debt. That went over really well, just about like the silence you just heard.
Yeah.
And I told my family the same thing. I said, starting January 1st, 2008, we're going to find, some charities, some nonprofits, church, et cetera, that we really care about. And we're going to give a set amount every single week, and we're going to see what happens. Well, 4 weeks into this, Evan, I was talking to a real estate developer. It was actually quite random at a Subway restaurant. And I was talking to him about the quandary I was in this 5-acre parcel I wanted to subdivide into waterfront lots. And he said, oh, you ought to try this. And that little light bulb thought he planted turned into a completely ridiculous way of circumventing this legal thing that would keep me from subdividing these lots. Now, of course, I wasn't going to do this under the table. So I went and met with the county planning and zoning people 2 days later. And I said, hey, I found in your law that you say this, but what about that? And I turned it and I said, but couldn't you look at the wording this way? And the lady was shocked. She said, I've been working here for decades. No one has ever seen that loophole in the law, but you're completely right. And nobody could stop you from doing that. And so now there was a lot of sweat and pain and a few sleepless hours in the next 13 months. But 13 months later, Evan, I was completely debt free.
Wow. So, yeah, I mean, I love that. The fact that, you went through a very, probably very trying time for yourself where you're like, you're in a quandary, like you said, you're in a tough spot where you don't really always know what the next step should be.
Mm-hmm.
But you just decided to come at it from a place of giving and a place of like actually looking to help other people and looking to serve other people. And then an opportunity presented itself that, you had not planned on at all.
That's for sure.
That's amazing. Um, I just love the fact that, that's something that I deal with on development too, is like always looking at unique opportunities to be able to look at things at a whole new way.
Mm-hmm.
And I think that's another thing too. I mean, the fact that he gave you a whole new perspective and
Mm-hmm.
trying something that's creative, that's out of the box.
Right.
I think that's something that everybody should keep in mind as they're trying to problem solve.
Yeah, I'll tell you what, if we get together in Nashville next week, I'll tell you the whole story because it's actually quite detailed and it's kind of geeky developer stuff. I think you'd love it.
Yes, I would. Well, so going into all that debt, I mean, what was that like having that, I don't know, that burden on you, and then being able to actually come out of there, with both feet on the ground and moving forward?
It was amazing. I mean, at the time, I think it's actually more epic now looking back at it, over a decade later, than at the time. Of course, at the time, there was meetings with bankers and meetings with mortgage people and pulling my hair out, with a surveyor and all that. So at the time, it seemed like a lot of grunt work, but now it seems like a great story. I don't think I realized, I don't think at the time I really took into account how much risk I was taking going from 2004 when things were booming in the real estate market to late 2007 when they were really screeching almost to a halt. I don't really think I took into account how bad, of some of the decisions we were making and the debt we were going into, how bad it could have been. And I think it was Fortune or Entrepreneur Magazine had a big cover story about 2007 saying the real estate bubble is about to burst. And you know what? I had to ignore the facts from that. And you know how you do that? You've got a track you're running on, and you start looking for all the evidence that
Yeah.
backs up your story. I know they call this something in psychology. And then you look for, and you ignore all the evidence, or you find a way to justify, well, this time it's different. Well, you know what, folks, if you're thinking we're going to have a recession again in 2019, 20, or 21, and you think, but I'm an exception, this time it's different. You know what? You're probably wrong. It's probably not different than, thousands of years of Earth history have shown us, from the tulip bulb craze of the 1600s in Holland to, Bitcoin here in 3 years ago. It's speculation is still speculation. And real estate investing has opportunities to not speculate and to really invest. And that's one of the reasons I love it.
So what advice would you have for somebody that, if they had the same situation you had, where maybe they had some failures, or they're going through, a tough situation where, they have debt or they have a burden on them, whether it be financial or even mental, or something they feel is holding them back. What advice would you have, given your experience of overcoming that and looking towards creating a better future?
I would just really say, look, I really believe that the law of sowing and reaping, or some people in the East might call it karma. I really believe that's a universal law, and it's really true. And I would look for opportunities to basically act in the opposite spirit to the situation you're in, or to basically, to give of your time, of your money, of your talent, when you might feel like you're scrambling and scraping just to get by. Give something away and you'll be surprised. I don't think there's some vending machine in the sky and this always works automatically every time. But I really do believe the law is, the principle is true. And so that's the one thing I would leave with people.
Yeah, I love that. And I think you're exactly right. That's powerful, to always come from a place of how can you better serve other people,
Yeah.
and inevitably it will likely help you as well.
Yeah, it's really true.
So going to what you said about recession-proof investing, and also you brought up a great point of, like, going into, we're at what seems like the top of the market, and nobody knows when it's going to turn, or what the turn's going to look like. How are you best protecting, and how can others best protect themselves, from any sort of change in the market?
Yeah, so Warren Buffett talks about investing with a margin of safety, or a buffer. And basically that is, buying not, yeah, Howard Marks also, he's a Warren Buffett, a friend of Buffett's. He's got a book called Mastering the Market Cycle, Getting the Odds in Your Favor. And I think that if right now you're barely eking out a profit, on your pro formas when you're thinking about making an investment. And if we are at the top of the market and you have to count on appreciation to make your deal work, maybe that's a bad idea. Maybe you should try to think like Buffett and try to either be selling when everyone else is buying. Of course, he says be greedy whenever others are fearful, and be fearful when others are greedy. But you should also be working in a large margin of safety. The closer we get to the top of the market, the larger the margin of safety, which is flying straight in the face of what a lot of people are doing in times of unbridled optimism. And for me, the margin of safety is buying right. And that means buying mom and pop owned and operated, whether it's apartments, self-storage, mobile home parks, buying mom and pop operated assets with a whole lot of potential. And that is, to me, one of the great margins of safety. A second piece of that would be buying assets that are generally recession resistant. And what I mean by that is this: if you look at the statistics of mobile home parks in the last recession, there was absolutely no dip at all. Now, apartments and self-storage had a dip, but their dip was far, far less severe than other asset classes. In fact, at the height of the recession, Freddie Mac and Fannie Mae's apartment versus homes were delinquent up to 4.4%. I think private banks had up to 10% delinquency and foreclosure rate. Apartments had like 0.4%. So they were 90% lower than the best measure of houses, and like 96% lower, I think, than a lot of the private banks. Okay, that's apartments. Self-storage and mobile home parks, from what I understand, did even better. And you can think about why. When people downsize their home, they might go to an apartment. When they downsize from an apartment, they might go to a mobile home. When they downsize from a mobile home, where are they going to go? Well, under a bridge. I mean, it is the cheapest form of housing out there. And it's probably the bottom rung on the ladder. And so typically they actually kind of have a buffer, if you will, during a recession. Self-storage is similar. When people downsize, they need a place to store their stuff. And for a very small percentage of their income, they can store their stuff in self-storage. In good times, they need a place to store their stuff because they're buying more. And they, so self-storage has done really well in both economies. The problem with self-storage is you can get certain areas like Nashville, in fact, that are overbuilt. And so that can cause a problem. And that problem is not there for mobile home parks because they're actually dwindling in number every year. So it's a really powerful asset class.
Yeah, that's interesting. And I guess one question I have is, I've looked at other operators' pro formas. I've seen what they're offering, and I've seen a lot of like healthy optimism. And like you're saying, it's like trying to eke out every last inch of the pro forma, and really being optimistic and bullish on appreciation and in every year of the future, and not taking into account any sort of margin, as you say, as Warren Buffett says, like not having any margin for error. And so I just want to know your perspective on what you're looking at as far as like how long are you trying to hold on to your properties, and what are you looking at as far as like expected growth of like the exit cap or different things like that. Like how are you looking at that perspective of it?
Yeah, so a lot of people, are, historically the cap rate, backing up, the value formula for commercial real estate is really powerful. It's different from residential. It's basically the income divided by the return, or more specifically, value equals net operating income divided by cap rate. And so a 10% cap rate, which was kind of normal historically, meant that people expected a 10% annual return on investment, not including the debt service. But now it's dropped to about half that, to like 5% in a lot of markets. And so if an operator comes to me and says, hey, we're buying at a 5.5% cap and we're assuming we're going to sell at a 4.5%, I'm going to have really serious problems with that. I'd rather see an operator, even if they had good reason to believe they could shrink the cap rate, and it is possible, by the way, I would still rather see them underwrite at a more conservative, expanded cap rate, let's say 7%. Now, Evan, there are advantages to people who are positioned to hold and want to hold long term. Think about this. In let's say a recession, sometimes, and maybe not this time, but sometimes the interest rate might go up. The cap rate correspondingly will go up. But what also could happen, especially if there's inflation, is there could be an increase in rents and therefore an increase in net operating income. Okay, so while the cap rate is expanding, which means the price of the asset's going down, your income above the
Right.
numerator of that equation might be going up as well. Well, here's the advantage of a long-term holder. If you're forced to sell for some reason because of your debt or your equity partners in 3 years, you might hit the wrong part of that cycle. But if you're a longer term holder, let's say you've got 12-year debt like we have on our apartments, um, what could happen is the cycle could go back in the other direction. Inflation could cool off. The cap rate could shrink again. The interest rate could shrink again, but typically rents don't shrink. So if your rent through inflation went up from $1,000 to $1,200 a unit, typically that rent's going to still be in place, and therefore your net operating income will be intact, and your value of your asset as the cap rate shrinks again, let's say in year 7, 8, 9, 10, can be very significantly higher. And so I think there's a long-term advantage. And so we want to invest with operators who are positioned and able to hold longer term.
Yeah, I couldn't agree more. And I think it also goes back to another Warren Buffett principle of investing is that, he always says, he's like, I won't invest in something that I don't want to hold for the long term.
Right.
And that's exactly how we approach our investments is, it's looking at, say, hey, are we willing to be able to hold this for the long term for 5, 10, 15, 20 years, whatever it is, looking at that longer term hold and making sure the numbers still make sense.
Yep.
Because you're exactly right. I mean, that's part of what happened when 08 with a lot of groups that, had a cash flowing multifamily property and had to have it foreclosed on or couldn't refinance it because the loan
Right.
came due at the wrong time.
Right. Yep. It's very true. So we definitely, we love, Buffett, what his ideal holding time is forever. And he also talks about, investing in stuff and then not even looking at the stock price for like 5 or 10 years because he can see the value in the underlying asset. And, Buffett has bought a lot of mom and pops. He bought a mom and pop jewelry store and a mom and pop furniture market and a mom and pop other things that he is under his tutelage have just exploded, So he likes that margin of safety as well.
Right. Yeah. Including Clayton Homes and
Right.
manufactured housing.
Yep.
So going into what you said previously, I love that you said, give of your time, give of your money and give of your spirit. So what are you doing? What are you and your family and your company, I guess, doing to give of all of those?
Yeah. So, a couple years ago, I saw a movie called Nefarious. And this documentary on human trafficking shocked me, opened my eyes to the horrors of human trafficking. Though the documentary didn't say this, I'll say it. If you took the record profits, and I don't mean the average profits, Evan, the record profits of Apple, General Motors, Nike, and Starbucks, added those together, record profits, doubled it, that would be the approximate total revenue generated by human trafficking every year. It is astounding. It's
Wow.
huge. And, I'd like to believe if I was alive in the 1800s, I would have been an abolitionist fighting, against slavery and fighting for freedom. Or if I'd have been an adult in the 1960s, I would have been fighting for civil rights. Well, this is a civil right. It's been ripped away from 20 to 40 million people, and it is slavery, and it's happening right under our noses. So I'm doing everything I can to tell people about this, and our goal is to fund fighting human trafficking and rescuing its victims in a large way. So while we're still in the early years of this right now, we've got some big goals. I'm working with a group called Freedom Place Project. You can find it at freedomplaceproject.com. We're not taking any donations. We don't need donations. What we're going to do is we're planning to build $1 billion office tower in Dallas. And we're planning to use, of course, we'll pay the investors, we'll pay the lenders, we'll pay the construction folks and architects, but we're planning to use 100% of the developers' profits to fight human trafficking and rescue its victims. And then if that works, we plan to take the Freedom Place Project concept and roll it out into other major cities across the nation.
Wow. That's impressive. I was not expecting that. That blows me away. Yeah, $1 billion. That's pretty amazing. So why this structure and why an office building in Dallas?
Yeah, it turns out that, I mean, this was not my idea. I'm just on the board of this, but the guy who came up with it comes from, he's a third generation real estate developer and investor in Dallas. And so it was a natural fit for him. He's got lots of great contacts there, a few names that people would recognize are interested in partnering with us. And so we're really excited to get this off the ground. We're looking at land and possible building, architecture right now.
That's great. And I love that you're marrying two of your passions together of real estate and helping others and helping with a civil rights issue on an international scale.
Yeah, right. Thank you. It's exciting. If people want to know more about that, they can find the Nefarious movie online. They can rent it. They can also go to exoduscry.com to learn more about what Exodus Cry is doing. And there's other groups, IJM and others as well, are doing a lot in this arena.
That's amazing. And I encourage everybody listening as well to take him up on that, and then also find your own way of marrying your passion, excuse me, your passion um, to something that you want to serve and help others.
Right. Yeah, I totally agree. And it's, when I sold my company, I was, like I said, I wasn't even 34 yet. And I had a couple $1 million in my bank account, and people, we kind of fantasized what that would be like, especially at a younger age. I wasn't any happier the day after I, sold the company than I was before. I wasn't any happier. I didn't feel any more fulfilled. It felt good. But you know what? I needed a big why. And I recommend that all of us have a big why.
Yes. And then that's exactly what when I talk to people and helping coach them on their real estate journey and their investing journey and their life journey, that's something that is always top of mind and always one of the first things that we're talking about is, honing in on your why, honing in on who you are and the purpose that you want to serve.
Yeah, absolutely.
So let's just jump right into our monumental questions.
All right.
So what does success mean to you?
So I just wrote a blog post for Bigger Pockets, and also I have an e-course that I'm developing. And the first module of the e-course is what is wealth, or what is true wealth. And for me, I could have gone down the road of saying it is spiritual in nature. It's having a happy family, a great marriage, great relationships, serving the community, having a big why. And I think that's all great. But I think success is also, I think we should look at the nature of true wealth. And I think it's pretty simple. True wealth, in my mind, are assets that produce income. It's not just having a beautiful car, which is a depreciating asset, probably an asset of your banker, by the way, or a mansion, which is also an asset of the mortgage company, typically not yours, unless you paid it with cash. But at any rate, assets that produce income, to me, is true wealth. And so that's why I love commercial real estate investing. And so that, to me, as far as wealth, that would be success. As far as success in general, it would be the other things I mentioned earlier.
Yes, I love it. So what about your daily habits or morning rituals that you have?
Yeah, so for over 30 years, I've had a morning ritual where I try to spend some time in journaling, meditation, reading ancient scriptures, things like that. And right now, I've married one of my passions, which is writing. With that, lately I've tried to restart something I tried about 15 years ago, which is actually writing little devotionals, like these little, 1 or 2 or 3 page devotionals. And I'm actually marrying science and amazing facts from science to just a meditative, kind of a daily thought for the day. Well, this star burns 5 billion times brighter than the sun. Well, in that case, and then I will try to relate that to something
Yeah.
about the person's day.
Interesting. That's really cool. So that's called a devotional.
Yeah, it's just kind of like a devotional journal or something. I'm trying to get up to 100, and then I'm going to run it by my publisher to see if they want to publish it.
That's really cool. Well, guys, be on the lookout for that if that's going to come out at some point. That's really cool.
Thanks.
So what about your favorite book or book you're currently reading?
Yeah, so I've been fairly obsessed lately with a book by a guy in your hometown, Donald Miller, and the book is called Story Brand. And the Story Brand book, he's taking a 2,000-year-old concept of storytelling, and he's teaching us to tell stories when we talk to our customers, in our business, for our websites. He's basically teaching a storytelling way of copywriting. I love writing. I love copywriting. Well, he's taken it to the level of putting it in story form. And of course, our customers are always the hero of that story. We're not. And so I'm really enjoying that book and that concept right now, but fairly obsessive with it. Even this morning, I spent a couple hours on that.
That's really cool. And I'll have to check out that book, and it sounds like something that would be right up my alley.
Yeah, you should. Yeah, you should get Donald Miller on your podcast if you can. In fact, if you get him on yours, let me know. I'd love to have him on mine. He's, like I said, he's in Nashville, and he's got his own podcast, the Story Brand podcast, that I've really enjoyed too.
That's great. Yeah, we'll have to make that happen, both of us. So in closing, how can our listeners follow you or reach out to you, Paul?
They could come, of course, on Bigger Pockets. I'm all over there. I do live events on there, as well as blogs. And but the best way to reach me is at my website, which is wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com.
I love it. Guys, take Paul up on that. And also, he's adding tremendous value over at Bigger Pockets, like he said. And we're actually going to meet up here in Nashville just in a few days. So make sure to follow Paul. And if you guys enjoyed today's episode with Paul, make sure to share it on social media. Tag Paul, tag myself. And with that, have a monumental day.